All right, welcome to already the last week of the analyst month right here, where we are going to start off with understanding the context area. That is the area where we are in the execution month, the next weeks, going to look at our entry. So it's the last part before we dive into the execution month as well. Now, a quick reminder of the foundational levels right here of the basis is we have bias, narrative, boundary, and target. Number 3 and 4 right there, boundary and target, create together the context. So boundary is the first part of the context. Then the second part of context is the target. After you have those two and you have context, that is when you can move on towards the entry. So sometimes I refer to 5 foundation levels. Sometimes I refer to 6. Usually when I refer to 6, it's because we're going a little bit more in depth because we dissect that context actually. Now, understanding as well, of course, the foundational levels for the analyst phase where we went over the bias and the narrative, why they are green, they're checked off. Then in red, we have a boundary and target, which is what we need to go over right now. Then first things first, what is actually context? First, we have bias, and bias again creates that direction because bias is understanding that drawn liquidity. Which PD array are we actually aiming for? And how can we know which PD array we are actually aiming for? Creates the bias, the direction. Then we have the narrative. How are we getting there? So if the bias is bullish, then how are we getting there? How are we getting towards that premium array that we are actually looking to target? Then we have context. Context is the area where we now scout for an entry. Also known, like I mentioned in the beginning, the context area. And the context area is exactly the area where you can look for an entry on the lower time frame, for example. And the context exists of 2 components, where we have the boundary, and I have narrative right there as well, because it's closely related, but it's not exactly the same. Then we also have the target right there, which is the second component, the second part of context. So let's first go over the boundary, where part 1 of context is the boundary. Now we need to understand narrative and boundary, they are like brothers, blood brothers. They are somewhat the same, but also not the same, right? So the main difference between a narrative and a boundary is that the narrative is not accurate, or at least is not usually not that accurate. Where a boundary, we have to be accurate, because if we're not going higher off of that specific PD rate, then we're likely going to take a lot of losses on the lower time frame. So what do I actually mean with that? Well, if we take a look at Australian dollar, US dollar right here again, then we work with order flow lags, right? So off of that order flow lag right there, we have multiple discount arrays that we can essentially continue higher from. We have this fair value gap right there. Then we have the fair value area right there. Then if people were not too sure what to mark out, they would also mark out the bodies right there and this fair value gap as well. This breaker, small little breaker, and even the bodies right there. And then don't forget about the last line of defense also sitting right there. So you have a lot of discount arrays sitting right there, which create a narrative. Because if we are going higher, where are we going higher from? Somewhere in this lag, we are going higher. So this lag is going to hold to push higher, most likely. But if that does not happen and we do not continue higher off that first one right there, then a lot of people will look at entries at every single discount array that we might have there. They're imagined lines almost, and it becomes a support and resistance story almost, where we look at every single line to look for an entry. So it becomes random. It loses its accuracy, which is very important, because if we take a loss at every single of these discount arrays, then let's just say we take a loss at every single one. We have one fair value gap right there on that first day. Perfect. 1 loss, 2 losses, 3, 4, 5, 6, potentially 7. And once we come below that low, potentially 7 right there. Now, that's 7 losses. Let's say we target a 1 to 2 RR. We now need to have, what is that? That is 4 winning trades if we want to get back into profit. That's not what we want to do. That's a pain in the ass, to be honest. That is not nice. Drawdown is just simply not nice. So where the boundary comes in, and the difference between that boundary and the narrative is the boundary, you are going to be more accurate. You're going to be very picky about which PD array you are actually looking for an entry off of, which is arguably the most important part right here. Because everyone can guess which PD array we might want to continue higher off of, but the real traders and where the real profitability is understanding where we are most likely going to continue higher off of. Because in the previous videos, we went over and we hammered this down, is the first PD rates that we have right there. If you do not select the fair value area correct, if you have different PD rates on your chart, then you're going to lose accuracy and it's not going to work essentially. So here, the only thing that we can continue higher off of is what we mentioned, is this line right there. So let's say at worst case scenario, we take a loss right there. We only take one loss right there in this whole price action lag higher. And after that, we might have even taken a sell to continue lower. So we take another winner, which could put us at a 1 hour profit. Now, let's say we didn't take that winner. All right, we are still at -1. Perfectly fine. Or we took a break even right there. But worst case scenario, we took a loss. Now, that again gives us a lot more accuracy to work with. And that is exactly what the boundary is about. The difference from the narrative is the narrative, yes, sets you up for that potential of accuracy, but the boundary, you really need to be accurate and you need to be almost quite certain that this is the PD rate that we are going to continue higher off of. Now, that is of course where the previous videos always come in handy as well. Then the next part is in that boundary is the 2 candle rejection. And we have a sweep. Now, right there, I want to go over the chart, but before I do that, I want you to understand as well what the boundary actually is and why it's called a boundary in the first place. A boundary is essentially the narrative PD rate, but with more accuracy again, the narrative PD rate right there, that you are now going to go into the lower time frame. So when that PD rate is hit, it creates a boundary for you to go on to the next step to look for an actual entry pattern. Once you have the target, of course, as well. So that is why it's called a boundary. It's a boundary to form or to essentially get to the next step as well. Once we cross that boundary, we can go to the next step. So with that understanding of that boundary, then again, what can create that boundary? Well, a usual boundary is going to be a fair value gap or a fair value area. So again, depending on how the overall price action, there's a lot of variables going into that, right? Because we went over that in the previous videos as well. Now, right here, for example, the boundary was this fair value area where we could continue higher off of. And it was also sort of understanding that 2 candle rejection was the last line of defense. Because after that, we could not continue higher off of that anymore. And we were most likely going to continue lower because we're not offering that fair value anymore. So this right here creates a boundary. Again, it's usually going to be a fair value gap with or fair value area as well. Now, there are different kinds of boundaries as well. Because if we have a sweep or we have 2 candle rejection, it's not always going to be the exact same. Where once we find a boundary, for example, this boundary, you can go into the lower time frame as soon as we hit this line right there to scout for an entry to continue higher as well, which is all things we're going to go over in the execution month, of course. But like we mentioned, we need to understand the correct boundary because we have another fair value gap right there continuing higher as well, which we can potentially continue higher from. Now, in the first day, we do not actually continue higher right there. So we might have also on the lower time frame not got an entry pattern just yet. But what at that moment in time is now the exact boundary because it's not the fair value gap anymore. It could be, and we could argue that it is the order block right there, but there's a different discount array sitting right there a little bit higher, which we can continue higher from right now. And that is the previous candle low. So in this case, it's a little bit different where the boundary, the PD rate, which we can actually continue higher from, which we can now, once we hit that PD rate right there, we can look for an entry, is actually the previous day low right there. So that creates a funny thing right there because a lot of people think we're still continuing higher off the fair value gap. No, it's actually a new discount rate in the making, the previous day low. So this 2 candle rejection, first candle does not reject. So the second candle is likely going to reject off of a new discount rate, which is the previous candle low located right there. So that creates the boundary where we can now look for our entry, not the fair value gap anymore. Why is this again important? This is extremely important to understand when we do go into the execution month because it creates the same phenomenon like we saw on Australian dollar, US dollar, where if we keep on looking for entries at every single random level, then this whole fair value gap is, and this is daily fair value gap. Imagine if we go into the 15-minute time frame, how many fake moves we have going higher right there. we want to be accurate about the place that we are actually going to continue higher from, which is seen on the daily right here. So that's why we use the previous candle low as our boundary right there to continue higher from if the first candle does not reject already. So to give you a good idea as well on this, because I know a lot of questions will arise from that as well. Do we then wait for the first candle to close or not close or reject already off that daily value gap? No, you can already go into that first candle right there to look for an entry right there. But this is also where eventually time comes in, because usually when we have a low close like this, we come into this daily value gap, for example, we come into that late during that candle right there. So late during that day, for example. That is why we have a low close, because we have no time anymore to actually expand higher. So that is where you would not even be looking at an entry in the first place. So you would already be waiting for the next day for an entry. So the next day, when you have your new session to trade, that's when you wait for the sweep of the previous candle low to then continue higher instead. These are all things we are also eventually going to go over on in the execution month, where you actually look for your entry. But this right here is extremely important to understand. Now, when we have a low close in a discount array, that 2-candle rejection variable again of that boundary, then I like to go already into the entry confirmation time frame. But when I'm looking at a sweep boundary, it's a little bit different for me. So for example, in the previous example on GBP Canadian dollar, I mentioned in that off of that previous candle low, you can go into the 50-minute time frame to look for your entry, for example. All things, again, if you do not fully understand that, all things we're going to go over in the execution month. But I need you to understand right here that off of a sweep, and a sweep right here is a swing low or swing high. So I'm not referring to the 2-candle rejection, previous candle low, previous candle high, a swing high or swing low. And we expect a sweep to continue higher off that. And that sweep is not where I would want to go into the lower time frame. It's actually where I want to go down a singular time frame instead to find a fair value gap now supporting the idea of actually continuing higher. So as soon as we have that right there, then we can again use the fair value area, use the seeking liquidity method that we mentioned, using that third candle fair value gap that we mentioned to then look for a new entry. So right here, if we see this breakaway gap, for example, like we mentioned in previous videos, and we go down a singular time frame, then right here, we can now find new boundaries in the form of these fair value gaps again and fair value areas to then continue higher off of that instead. The reason that's important is because I do not want to go into this sweep, that daily sweep, to then go trade a 1 hour sharp turn higher or a 15-minute ST plus RE, all things we're going to go over as well, to then continue higher. So I do not want to look for an entry confirmation just yet. I want more confirmation first, because a sweep is always a little bit tricky to actually know where you and exactly get that same accuracy as you can get off a fair value gap and a fair value area. So to get that accuracy again, simply what I do is wait for a new fair value gap right there, which creates a new boundary, new fair value area to as well continue higher from right there, where now we can go into the lower time frame to get that more accuracy, because we are actually confirmed to continue higher as well. Now, next to that, we have volatility, and I don't want to go too in depth on that just yet, because I want to save it for the execution month as well. But the volatility is also extremely important to understand. For example, if we are expecting a discount array on a daily time frame to hold, then like we mentioned earlier as well in this analyst month, you would want to see the rejection happening on a day where we have news, the economic calendar supporting the ID. So what does that look like? So right here on the dollar, I have this as target, really quick. Don't want to go too in depth on that target right now. But if you study the chart, you'll also see why I have that target. Then right here, we have a fair value area with an overlapping fair value gap right there. Beautiful, beautiful. So I believe this to be a boundary right now. I want to use that as my exact boundary to then continue higher from. So at this area, I want to look for my entry. But on this Monday, we did not have US dollar news. So if we were to arrive on this Monday at that boundary, at that line, I would not want to look for an entry, because the volatility, again, the way I see it is it's energy. So if price needs energy to actually move somewhere, to actually make something happen right there, it needs volatility. So if we come into a discount array, that is price agreeing. That's the first part agreeing. When price agrees, we don't take into consideration time. But when time is now also agreeing with price, as in we have a volatility, we have the economic calendar news supporting the ID, actually trading that particular day. So we have US dollar red folder news, like we mentioned in previous videos as well, supporting the ID of trading that day. Then we have price and time agreeing. That is exactly when we can look to continue higher. So on this Monday, if we arrive at that boundary, I'm not interested to look for an entry. But this Tuesday, once we do have news, and now we sting into the discount rate to then continue higher, that's exactly when I want to look to get involved. So a boundary needs to have some sort of volatility supporting the idea as well, which is again time. More on time later on as well in the execution month. Now, before we go over different types of context, different types of boundaries as well later on, we first need to go over the second part of context, because part 2 of context is again the target. So where we have a boundary, we also have a target. Immediately after that, we also have a target. There are different types of targets. The further we move to the right here, the lower probability it is going to be, because we have more resistance going against us. So what I mean by that is also what I'm going to show you right here. Now, first target, and this is where we have the least resistance, so it's usually the easiest target, is a previous candle high, or I have previous candle high as well, but it's previous candle low, of course. A little typo, excuse me for that. Then, in the case where there's only a previous candle high or previous candle low as first PD ray, then that is our context target. Now, in order for us to understand that, let's also go over the different points right here. We have swing point. And in the case where there's a previous candle high, previous candle low, but also a swing high or low, when a swing high, then the swing high or low is our furthest context target. So the context actually becomes the swing point instead, not the previous candle high, previous candle low. Then we also have a case where, and this is the last case, where we have an FVG. In the case where we have an FVG as well, then that in itself is already low probability, and we need to take that into account when managing our risk. So what I'm referring to there is an FVG that has not been traded back into, of course. So let's go over the different examples and what I mean with it as well. So right here we are on NASDAQ on the weekly time frame, and I need you to understand as well the boundary and the target of that context area. A context area is always going to be on the same exact time frame. So I'm looking at the boundary right here on a weekly time frame in the form of this weekly Verweij gap, for example. Then the target of that context area, also known, and I often refer to it as well, as a context high or context low. In this moment, at this moment in time, it's a context high right there. That is going to be the target on the same exact time frame as the boundary time frame right there. Or in this case, is the weekly time frame right there. Now, what can we see? When we come into this boundary right there in the form of that weekly Verweij gap, the only target that we have right now, and what I mean with a target is, when we come into a boundary in the form of a discount array, the target is going to be the first opposing PD array, where in this case is the first premium array that we actually come into, that we can trade into. So at this moment in time, the only premium array that we have right there, and the first one we actually will come into, is this previous candle high. This scenario is quite high probability if we do want to continue higher, because there's not a lot of resistance going against us on the weekly, because it's only a singular candle right there. So that's where we can deliver quite quick. After this week, of course, now it turns into a swing high right there, where that eventually becomes the target right now. And that is the context high. That is the context target right there. So again, it's the first opposing PD array. So when we're looking at a premium array to trade off of, then it's going to be the first discount array. If it's a discount array that we're looking to trade off of, which is our boundary, then we are looking at the first premium array to target, which in this case, again, is that previous candle high right there, which eventually turns into a swing high. That's why we have the different scenarios. You have the previous candle high. If there's only a previous candle high, previous candle low, perfect. If there's a swing point, then it becomes a swing point, which is the next example we are also going to look at. Now, before we do that, again, I want to mention, if you use any other PD array, inverse Verweij gap, it's going to mess up the whole chemistry of this strategy, of the concepts that we use right there. So we essentially can't do that, because then it becomes Very weird how everything is combined as well, becomes very random, loses its accuracy. Now, looking at this scenario right here on Australian dollar, US dollar, we had this boundary right there on the 4-hour time frame. And we not only have, so what is our first premium array right there, which we are coming into, we not only have this previous candle high, but in the same leg lower, without a fair value gap right there, we also have a swing point right there. So the swing point actually sitting right there, that is the context high of this particular time frame. Now, of course, in different types of context, you can, in the lower time frame, also have context. So it's all fractal. So you have context and context and context. Because, for example, if we go into the daily right here, and we are looking at this particular sweep with this discount array right there, then of this discount array, the first premium array we actually trade into is this right there. So we have daily context, and inside that daily context, we had 4-hour context right there again. So inside that 4-hour context, if we go even into the 1 hour, for example, we might have even 1-hour context. We might even have 15-minute context right there to continue higher off of that. So you can have context in context in context. But the very important thing here to understand is why, for example, does this 15-minute fair value gap right there not hold and not push higher anymore? Because it's out of context. So what does that mean? Well, we are trading 4-hour context at this moment in time. So off of this gray box, it's the 4-hour value gap right there until this 4-hour swing high right there, which is the context high because we have previous candle high, but we also have a swing point. So then it becomes a swing point right there. Where yes, the previous candle high on the 4-hour right there can still be used as somewhat of resistance, right? So if we run that high, perfect, we can look to then target the swing high right there. It's first resistance area. But the ideal context high and the ultimate, the furthest context high right there is actually the swing high. As soon as we reach a swing high right there, that right there is now context taken. Context is gone. So what that means is from this fair value gap right there, from the low right there, towards that high, this on the right side of your chart is your context area. And the context area is where you can look at lower time frame fair value gaps, lower time frame order blocks to hold until we reach the context high right there. That is why it's so important to understand that target. Because if you do not have the proper target and you are still looking to trade off of, to trade towards that daily high right there, coming off a 4-hour context, then this 15-minute value gap, yes, that might fail because context is taken right there. Fair value gaps, order blocks, they hold inside context areas. So let me tell you how I actually got to this point and how I got to this understanding, because someone didn't just magically tell me this. I all studied this from my own perspective. And the way I got to this is every single day I went into the chart and I looked at 15-minute order blocks or lower time frame 5-minute order blocks, fair value gaps that just held. And every single day there was something similar on different pairs. We always had some kind of fair value gap that was holding and that was pushing price higher right there. I did not look at the higher time frame at that moment in time. I was one of those people that just got into trading and just looked at the lower time frame because that's where the action happened, right? And when I saw that pattern happening over and over and over again, where we always throughout the day, we had a 5-minute fair value gap, 15-minute fair value gap, even 1-minute order block fair value area holding, then through my mind, it was like, what is the differentiator, or what is the same thing that keeps on happening right there? What is the pattern on why those fair value gaps on a lower time frame tend to hold? That is because they are in context of the higher time frame. So essentially the same thing is happening on the time frame above it. So for example, on the 4-hour, we are moving from that 4-hour value gap right there higher towards that 4-hour context high, swing high right there. So when I understood that, it all started to click, because that is essentially where everything starts to hold, where you can look for your entry. So that's how I sort of reverse engineered my whole trading plan, my whole strategy, where I worked my way backwards, not forward and I started on the higher time frame. No, I actually started on the lower time frame, and that's how I got to know these things. So this is what we are looking at, a market maker model. So this is essentially a simplified version right here of a market maker model, which we're also going to go deeper into in the execution month. But essentially what we're seeing is we are seeing that original consolidation right there of a market maker model. If you do not know what an original consolidation is of market maker model, it's essentially the context high right there. You do not need to know a market maker model right here because it does not add any value to it. It only confuses, I would argue. Where this is the discount area we can continue higher from. And this is the left side of the market maker buy model. And this is the right side of the market maker buy model right there, where we want to look to get involved until we reach the original consolidation in the form of that context high. After that context is taken, we now want to find new context. New context is usually going to be found on a time frame below. So where we have taken for our context, we ideally want to go into a time frame below that, 1 hour, to now look at new context as well. So looking at the dollar right here again, we have this fair value area that pushed higher towards that swing high right there. Now the context is taken. So when we have context taken, we need again new context because we're always trading in context. We always need context. So right here, the ideal thing, if you do not have context on the daily anymore, which at this moment in time in 4 hours, we have found new context in the form of that daily fair value gap right there, which we can now continue higher from, creates new context. If we do not have that, and let's say we do not have that in this scenario, then you can go down a singular time frame to now find new context on the time frame below that. So that's why I marked out that fair value area on the 4 hour right there, which lines up perfectly with the daily fair value gap, which we can also continue higher from right there. So that is how you find new context. And that new context is where you now want to look to trade off of. Now, to quickly go over the targets here again, we mentioned the previous candle high, previous candle low. Now we mentioned also the swing point, right? Now I want to go over the last scenario as well, the fair value gap. So in the case where we have an FVG as well going against us, that in itself is already lower probability. We need to take that into account when managing our risk. So what does that last scenario look like? Here on crude oil, and if we go off of the 4 hour right here, we can see this fair value gap that we have right there, which we could potentially continue lower from. Do I think that's the best boundary in the world? Definitely not, but we have that boundary right there. Where similarly, we also have this boundary right here and off that fair value area, which we can continue lower from. Now, in both these scenarios, we have a fair value gap going against us in that lag higher right there. So an ideal scenario is when we do not have that fair value gap because there's less resistance. So here on the same time frame where we create that context from this fair value gap right there towards potentially that low right there, we run into this fair value gap. So this is still the context low, the swing point right there where we left off in the previous example. But we do need to take into account that we now have fair value gaps going against us, meaning that we now have a resistance going against us where we could potentially continue higher from. So now we need to understand as well how we want to avoid taking a loss in there if we do want to actually continue higher. So that is where also what we are going to go over in execution month, because for that we also need to dive into the lower time frame actually right there. But just know when we had that fair value gap going against us, it's ideal that we first disrespect that fair value gap to then look to get involved as well. So first waiting until that gets taken out. And we can see the difference between this right here and this fair value gap, where this fair value gap is actually getting respected with a 2 candle rejection to then continue higher. So that is the third type of context target that we have right there, which is a little bit lower probability. And when we do have that lower probability, again, the thing I mentioned right there is that we need to take that into account when managing our risk. So think of when we do dive into the execution month, think of going break even earlier, potentially even lower risk, all things we need to take into account right there. Now, after this, we have now created certain context areas, and there's different types of context as well, because we have usual context, and we are always at any given moment in time, we are always trading usual context. That's the goal. We are always looking to trade usual context. The usual context is the examples we went over. So the fair value gap, the fair value area, where we have the 2 candle rejection and that sweep, that is a little bit different, but you're still trading after that usual context. So a usual context area is again that order flow lag higher or lower. That creates a fair value gap, creates a fair value area potentially, that creates the usual context area. Then next to usual context, of course, we have the opposite version, the other extreme, which is unusual context. When usual context fails, it creates unusual context. Unusual context is when we are not offering fair value, for example, we are then targeting that fair value area low or targeting the last line of defense, failing to candle rejection, all things that lead to unusual context. Now, what does this look like? So similar actually, here on crude oil, we actually see it happen where we have usual context and also that leads to unusual context. So this fair value gap right there is what we can continue lower off of. We are running into this fair value gap, which initially we might actually see lower prices. We might see that get disrespected. We still need to take that into account. So right here, we failed to create a fair value gap lower actually, which is already a little bit of a weird sign. So as soon as we have that and we do not have that usual context following through anymore, we might create unusual context. Where unusual context is where usual context gets taken out. So the target is not the usual context low anymore. No, it actually becomes the usual context high right there. When we create now again usual context targeting this high right there. So that is key to understand, because when we understand that, we understand again when we have usual and unusual context, and when one of them, most likely usual context, starts to fail to create unusual context to then create usual context again. Let's go over this again because it's a lot of unusual, usual, unusual, everything of that. All right, so here we are on Euro US dollar, and we mentioned in previous videos as well, we can continue higher after sweeping that previous day low. That news was not news day, so this day was the actual rejection to continue higher to potentially target this high right there. So that again creates the context area right there with the boundary and the target right here. Now that is where we can now continue look to continue higher. So let's look at this price action. If we want to continue higher, then currently we are failing to create a new daily value gap higher, or potentially, because it's a very small area right now, we can actually look to continue higher from. Let's mark that out right there. Then ideally, if we do want to continue higher, we should now find a discount array, which we can already look to continue higher from. On the 4 hour, we also failed to create a 4 hour value gap higher right there. And on the 1 hour, do we have anything else? On the 1 hour, we have this fair value area right there, where eventually the 2 candle rejection right there starts to fail as well. All these signs lead to usual context in form of the daily context right there that we had might not actually want to follow through. When that happens, that is not a lost cause. No, because that usual context failing leads to unusual context. So where now the target potentially becomes this low actually. And since it becomes that low and this whole idea is failing, now, like we mentioned as well, it potentially becomes this low right there. Now, what do we do in this case? In this case, we now need to find usual context again to target our new targets right there. So here we create that new fair value gap right there continuing lower, which creates again new context. We have this fair value gap right there, which we can look to continue lower from, and we have the previous candle low right there, which creates our context low, our context target. And then afterwards, we just need to find new usual context to trade the unusual context. So the way I want you to visually see this is we go from usual context. If that starts to fail, that creates unusual context. Then to capitalize on the unusual context, we still need, again, usual context to target the unusual context target right there. So it goes from usual, unusual to, again, the usual. A small little typo right there, but I think my point is clear. So let's take a look at this dollar example right here. We have this 4 hour fair value area, which we can continue higher from. Eventually, the swing point is sitting right there. So that's the context high. Now, if we do want to push higher, currently we have this fair value gap going against us. But the beautiful thing is this fair value gap has already been mitigated. So now has already been traded back into. So if we now trade back into this fair value area and we fail to create a fair value gap lower right there on the 4 hour, perfect. Because that creates, well, at least that does not have the fair value gap anymore right there. Now we can confidently look to target higher with less resistance because the resistance will already be taken out. When I talk about that fair value gap, and if it's lower probability, it's a fair value gap that has not been mitigated yet, has not been traded back into. like we saw on crude oil. So this right here creates the context right now that we can continue higher. If we want to actually continue higher right there, then 2-candle rejection should ideally hold right there. If that does not happen, we create unusual context where we can find usual context to then again continue lower instead. GBP Canadian dollar is a good example where we have been mentioning right there, once we have reached the target, we get early signs that this might be a sweep of liquidity instead, because we do not close above it. We have a huge rejection lower. After that, we also see this high also does not have fair value gap overlapping. All right, we have first line of defense actually being this order block, not the fair value gap. All signs that we actually might be sweeping that to continue lower. So this usual context area right here in the form of this fair value gap to then target that high is in itself starting off not a good boundary. It's just a very bad boundary in my opinion. It's really bad trading conditions right there to actually look to continue higher. But it can create unusual context already identified a little bit earlier on. So here, if we go into the 4 hour, for example, then this last line of defense is not the last line of defense that we expect to hold. No, it's actually our target right there. Where the first time we come into it, we have a battle again. It's 50-50 at this moment in time, because right now we are in between that premium rate and a discount rate, like we mentioned as well in earlier videos, right? Those low probability conditions. Then the thing we want to wait for is either a new fair value gap higher right there, confidently running highs, or a new fair value gap lower, confidently running the lows, which we do not get, but eventually we want to find, and our goal is to find new usual context to actually target lower right there, which is why we see that low getting taken out as well, with that whole thought process of the context and everything that went before in the previous videos as well. So from that, we have a good understanding of what actually context is. And when we look at context, we can now actually practice the context as well. And I would advise to study context areas, study the dollar. For example, the dollar has a nice context area coming up. We would like to see if that holds and continues the usual context, or if unusual context happen. That will be very interesting to actually see. So then on Wednesday, we will go over further targets. And after that, to end the analyst month, we will go over a recap on all the concepts as well, the top-down analysis and where we want to use the concepts as well. All right, perfect. Thank you.